There is an event unfolding right now in the upper echelons of global finance that Wall Street is going to great lengths to keep quiet. It is happening silently, buried deep inside the private strategy documents and model portfolios of the single largest asset manager in history, BlackRock. To understand the gravity of this, you have to understand the scale. They control $14 trillion. That is an almost incomprehensible amount of capital. It is more money than the entire gross domestic product of every country on Earth, with the exception of the United States and China combined. When a financial entity of that size decides to move, it does not do so lightly, and it certainly does not do so without a profound reason. On the 23rd of March 2026, BlackRock released their Q2 Equity Outlook, a document the vast majority of ordinary investors will never read. I've sourced the full report for you in the description below so you can follow along. Inside, BlackRock executed a telling portfolio pivot. They moved to a neutral position on U.S. equities and went underweight on long-term Treasury bonds. They explicitly signaled that their models were preparing for a stagflationary shock, and buried inside is a glaring warning about regional banks. It is a warning that should stop every depositor and investor completely cold. This isn't just talk, it's the movement of $13 trillion. When BlackRock repositions, the money moves first, and the media explanation comes second. The question is what they are actually doing with their capital. What they are doing right now is sending an undeniable message about the stability of your local community bank and the fragility of the entire system. BlackRock is not a bank. They don't hold checking accounts. What they do is manage the wealth of the world, pension funds, sovereign wealth, and reserves. They manage the retirement accounts of ordinary retail investors through their iShares platform, the largest ETF provider in the world. When BlackRock repositions, it is effectively moving the equivalent of entire national economies from one asset class into another. Institutional investors watch BlackRock like a captain watches a lighthouse. If that light moves, you know the rocks beneath have shifted dangerously. Right now, BlackRock is signaling that the rocks have shifted beneath the regional banking sector. It's a calculated four-part strategic pivot. First, they move from overweight to neutral on U.S. equities. In institutional finance, neutral is a reduction in exposure to the entire stock market. Second, they targeted small-cap stocks. This is exactly where regional banks live. When BlackRock pulls weight here, the liquidity drain is immediate. If you look at regional banking ETFs like KRE or IAT, they are composed of these mid-cap companies. They feel the drain first. Third, CEO Larry Fink went public. He warned that if the conflict in Iran persists, oil could surge to $150, elevating global recession risks. This wasn't theoretical, it was a siren about the macroeconomic environment. And that brings us to the fourth most critical vulnerability. The BlackRock Investment Institute stated regional banks face a specific structural vulnerability that mega banks don't: commercial real estate. Commercial real estate is the story of 2026. Commit this number to memory: $875 billion. That is the debt maturing this year alone. Office towers, shopping centers, multifamily complexes, and hotels. Loans borrowed at low rates are now maturing and must be refinanced at today's rates. Regional banks hold 44% of their entire loan portfolios in commercial real estate. Nearly half of their lending is tied to these properties. To put that in perspective, mega banks hold only about 13%. Regional banks are carrying 3 times the concentrated exposure. The trap has been sprung. The Fed is paralyzed. War in Iran sent oil prices surging over 60%. Brent crude hit $119. That energy shock translates to the pump. Americans saw gas prices spike $1.20 in a single month, a 35% overnight increase. OECD projects inflation could hit 4.2%. The Fed cannot cut rates to help real estate without making inflation worse. They are trapped. There is a 4-stage pattern running like a virus inside the regional bank system. Understanding it is the key to protecting your assets. Stage 1, the foundation. Between 2010 and 2020, ultra-low rates pushed banks on a search for yield. They moved aggressively into commercial real estate. Regional banks stopped being community lenders and functionally became commercial real estate lenders who just happened to offer checking accounts. Stage 2, overextension. The boom was built on assumptions that cheap financing would last forever and remote work was just a temporary anomaly. But remote work became entrenched. National office vacancy rates climbed toward 20%. Valuations assumed 100% occupancy that never returned. There's a hidden detail: the dual-sided poison pill. Banks locked deposits into long-duration treasury bonds that lost value as rates rose. When rates rise, commercial real estate values plummet, and those bond portfolios lose value too. It's a double hit to the bank's balance sheet. Stage 3. The crisis moment. We saw this in 2023 with SVB. It proved that in a digital era, deposits are highly mobile and banks are fragile. Institutional investors woke up. They saw the $875 billion maturity wall and property values falling 20 to 40%. The rot became visible. Stage 4. The institutional exit. The smart money quietly leaves the building before the fire alarms go off. Look at the performance gaps. Regional banking ETFs are down significantly, while mega banks like JP Morgan delivered staggering 30% plus returns in 2025. History proves this pattern. The savings and loan crisis of the 80s saw over 1,000 institutions fail. Resolving it cost $160 billion. Institutional investors reduced exposure early. The retail investors and depositors were the absolute last to know. They bore the heaviest losses. The second parallel, Japan in the 90s. Regional banks lent into a property bubble. When rates rose, values plummeted by 70%. They engaged in extend and pretend, leading to the lost decades, a quarter century of wealth destruction. Institutional investors exited years before. Finally, the 2023 stress period. U.S. banks were sitting on $400 billion in unrealized losses. That money didn't vanish, it's just being ignored. Applying this to April 2026, BlackRock sees 5 massive pressures converging. First, that $875 billion maturity wall. Second, a contagion in the private credit market. Major players like Blue Owl and Blackstone are struggling for liquidity and restricting withdrawals. Third, the oil shock from the war in Iran and the Strait of Hormuz. It's the largest oil supply disruption on record. Fourth, soaring recession risk. Moody's AI-driven model puts it at 49%. Nearly every post-war recession was preceded by an energy spike. The fifth pressure, institutional capital flight. BlackRock is leading it. So how do you protect yourself? Act with the precision of an institution. First, know your bank. If they are a regional lender with over 40% exposure to commercial real estate, you need to put them on a strict watch list. Second, rigorously enforce your FDIC insurance limits. The standard limit is $250,000 per depositor, per ownership category, per bank. Third, strictly separate your deposit risk from stock market risk. Your checking account is protected by the FDIC, but if your 401k or IRA is holding regional bank stocks or ETFs like KRE, you are holding full market risk. Finally, pay attention to where BlackRock is deploying capital. Their Q2 outlook is a roadmap. They're favoring energy, gold, and real assets. They are moving into the physical infrastructure of AI, power grids, and data centers, things that won't be obsolete by a software update. Banks will never publicly telegraph their own distress. No regional bank CEO will ever admit on an earnings call that they are terrified of their commercial real estate exposure. The signal has been broadcast. The only question is whether you will adjust your positioning before the rest of the market wakes up to the reality of 2026. For Paradoxical Pathways, this is the data you need to stay ahead. Be sure to subscribe and stay tuned as we continue to track the capital flows that the mainstream media is ignoring. I'll see you in the next one.